Good afternoon, ladies and gentlemen, and welcome to the Duke Royalty PLC investor presentation. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Just simply type in your questions in the box below and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company review all questions submitted today and publish responses where it is appropriate to do so. These will be available via your Investor Meet company dashboard. I'd also like to remind you that this presentation is being recorded. Before we begin, we would like to submit the following poll and would be grateful for your attention in that regard. I'd now like to hand over to Hugo Evans, CFO, and Neil Johnson, CEO of Duke Royalty. Good afternoon to you both.
Good afternoon.
Good afternoon. Thank you so much for everyone's attendance here. I'm Neil Johnson. Why don't we slip to slide number 3 and just give you Hugo Evans, as we said, the finance director, and myself, the director and founder and CEO of the company. This is the first time doing an Investor Meet company, and we're really excited to have this opportunity to interact with you directly, take your questions, and we will try to run through the slides and give you a sense of what we do at Duke Royalty. Hopefully some of you are shareholders, so we'll get to the questions as soon as we can. We wanted to put this slide up just to give you a sense of who we are. Our directors, FTSE 250, ex-FTSE 250 directors with management, fund management experience, and also our management with Chief Investment Officer Jim Webster, really a pioneer of this industry, over 25 years doing drug royalty, and was the first ever CEO of a public drug royalty company. So we're excited to have Jim and the rest of our team here, and we will make these people available for you at a later time. Our investor highlights. One of the things I want to begin with was just what we do. In a sentence, we provide minimally dilutive capital that provides no refinancing risk for private and owner-managed companies. And so you'll hear that coming through. We want companies with strong cash flow. It's been around for a long time, lived through crises, more than just the latest one that we've lived through this year. And that's what we do. We've been around for a number of years. We have an established portfolio. We're really here in the UK and Europe, having a first mover advantage, because this royalty sector has been around for decades, and it's lived through many economic downturns and good times, and it's a very investable sector, as I will present. What you should take away from this presentation, and really about what Duke Royalty is all about, is an income producing company and stock public company, but also has operational leverage. And as we grow, that operational kicks in so that there is capital growth as well. What we do is play as really an alternative finance company, the non-bank finance for small to medium-sized businesses. It is a very, very large industry. It's growing, and we feel post-COVID, and we'll talk about our favorite virus, post-COVID, this is going to be a bigger opportunity than we had pre-COVID. So we're, there is a silver lining for Duke in that we now are first mover in this growing industry. I talked about royalty financing being around a long time. Won't dwell on this side. Royalties, you have multiple sectors. Now representing a £50 billion industry for 40 years, so it has been proven to withstand market cycles. You can see some of the the latest ones in the London Stock Exchange. So we're excited to have more and more royalty funds and more royalty companies with us in the UK market. But I want to dwell on the fact that we have corporate royalties, which are a little bit different than just a fixed percentage of like a song or a drug. And so you have to think about this really as a long-term participating loan, which is engineered to have similar characteristics as traditional royalties. What Duke does is really put a lump sum capital to a company. So these are companies that are looking for capital, and we put a term of 25 to 40 years. Why? It's like the life of a mine or life of a patent, for example, and it's a long term, because what we do is there is no bullet repayment at the end of the term. So therefore, there is no refinancing risk for the business owner, and that is key, because we're a long-term partner of these companies, and that's a characteristic that you will find as we go through. Our initial yield, now that is a one payment, and that is adjusted once per year, as you can see, but that is the total obligation of the company, and there is no additional amortization payments, because the amortization is included technically in that yield. So what does that mean? It means that the total obligation to Duke, and by extension our return and the return for our shareholders, is really that one monthly payment that the company makes to us. So that can be serviced out of the current cash flow, and we do not need an exit event. We are here to provide a very long-term annuity-like revenue stream for our shareholders, and that takes the pressure off of the business owner to get off the kind of refinancing treadmill. Everyone wants their money back, whether it's private equity or a bank loan, and they have to refinance that principal. We take that away, and that, as you'll see, is something that business owners like in times of short-term uncertainty that we're working for here. We have a long-term view. But just like your house, it's like a corporate mortgage. This is what we tell our business owners. It's like you're taking a mortgage out on your company, and you don't have to live in your house when you take a mortgage out on your house. You don't have to live there for the end of the mortgage. You can buy it out, and we have that buyback feature as well. So no one has a 30-year business plan that we've found, and saying in 2050 this is what I want. Everyone's looking at the first 5 years, and we're no different, and our royalty partners are no different, but they have the ability to pay it back, but it's at their option. So the real key is that the control is in that owner's hands. The control of the buyback, the control of the refinancing event, the timing, and of course he or she keeps the equity in their hands and the control of the operations. So with that, I wanted to just make sure that everyone was absolutely crystal clear on how we make money and what it means for our royalty partners or our investee companies. So you might say, why not just a bank loan, private equity? This appeals to owners who have a need for capital but want to retain control. And so we're a little bit like debt and a little bit like equity, but it appeals to business owners who don't want to sell their company. That is the key. If you want to sell your company, you're going to go to private equity. And by the way, I don't want to invest in something that you want to get out of as a business owner. So we're looking for people who want to keep that control but have a need for capital here. And so I've highlighted the boxes. We really compete. These are the three things that business owners care about. it's do I lose control through a refinancing risk event? Do I lose control of selling my business and giving the control to private equity? Don't like that. And I'm only concerned about the first 5 years, but this is my livelihood. I need school fees and holidays paid from the dividends that I make. I can't impact my free cash flow that significantly with all these amortization payments that the debt comes with these days. So those are the three things, and we take care of those for the business owner. A lot of people ask about how we look for deals, how we evaluate deals, and how we are experts in all the industries. We'll get to our the breadth of our portfolio. I think that's a big strength when we talk about the established portfolio that we have. We'll talk about how we navigated COVID. It's really important to know that we have we evaluated a large number of companies, and those are three relationships. We're a first mover, so we are educating the market here in the UK. But these private owner-operated companies have trusted advisors in their accountants and their lawyers, and those are the people that we deal with in order to give them an option from just going to the high street bank and getting out another loan, because the funding gap after the last credit crisis, and I'll tell you, after this credit crisis, we're also going to have a funding gap. But the regulations changed in the banks, so they are disincentivized to give these type of loans to small business. It gets tougher and tougher. Of course, the high street bank is our main competitor, but British Growth Fund, for example, has grown up, come out of the last crisis and tried to fill that gap. And we're looking at a lot of opportunities, but we're not all things to all people. We only need to do 4 to 6 deals per year to keep growing and keep that operational leverage, as we talked about, that capital growth and income for Duke Royalty shareholders. So if there's never going to be a time that we have 100 companies that we're giving out checks to. We do significant due diligence. We look for the right opportunities, and we'll get to one of my favorite examples of what we do. But we boil those down. We have an independent investment committee. We have executives from Oliver Wyman, which is a part of a Fortune 500 company. He sits on our investment committee. Andrew Carragher, that runs a $1.5 billion private equity fund that he founded 20 years ago. He sits on our investment committee. We have royalty experts on our investment committee. We have that layer of filter. And of course, as you might, if you squint, see that we have global consulting partners, Oliver Wyman and McKinsey & Company, that help us evaluate as the commercial due diligence partner. We have a tremendous partnership with those companies that we do not ever have to write them a large check for a deal that we never did. It's really a percentage, an annuity of theirs with us, and so we're all in alignment together to get the best companies that fit our criteria and can withstand economic shocks, and then that goes to the board for approval. The board, as I showed you at the first slide. So that's the due diligence process. It takes about 3 months. It's very in-depth. Those due diligence reports that go to the investment committee and the board are typically 100 pages, going through all aspects of a due diligence that you would think. So, with Jim Webster and in our experience doing these types of deals, we're really proud of our process, and we're proud of our ability to evaluate these different companies. Hugo, why don't you take over? I got a little frog in my throat, so we'll give you slide 9.
Thanks, Neil. Yeah, I just wanted to touch on really sort of COVID and how it's affected our portfolio and our royalty partners, and what the response to that was. You know, as Neil said, we are long-term participating lenders. It's in our interest to work with our royalty partners to ensure their long-term growth, so that ultimately our cash flows can grow with them. So, you know, COVID has had a pretty profound impact on many of us, both personally and from a business perspective, and that's certainly true for some of our royalty partners who, you know, saw their revenue disappear from 100 to 0 almost overnight. So what that meant for Duke to preserve the long-term value was to work very closely with some of our royalty partners, and we structured forbearance agreements with 5 of them, which gave them a short-term alleviation from their interest payments, which allowed them to sort of remove that cash flow strain that they've had over the last 6 months. What that meant for Duke was a short-term drop in our cash revenue. Q1 this year, actually, as we sort of pre-COVID saw a record revenue quarter for us of 2.8 million. But Q2, that dropped to circa 2 million. So a 30% short-term drop in our cash revenue. But as we near the end of this calendar year, Q4, we've recently announced to the market that we should be expecting cash back up to 2.5 for the quarter. So we're now only sort of 10% off where we were pre-COVID levels. But that interest that has structured through the forbearance agreements isn't lost. So what have we done with that? Well, we've worked with our royalty partners, and in some cases, we've simply deferred that, and we fully expect the missed payments to be caught up over the next 12 months. And in 3 cases, we've actually equitized those missed interest payments. So rather than say, well, yes, we have a short-term cash impact, really what we've done is we've acquired future value. And as these businesses trade through the COVID time and sort of get back to a normal trading environment, we're now in a position to support these businesses, and we have a 30% equity stake in them for the future. So it sort of goes back down to the last point of a long-term approach, and Duke sees itself as a long-term support partner to these businesses. Ultimately, we want them to grow because as they grow, we grow with them. Just touching on slide 10, which is really sort of an overview of our current royalty partners. You know, it's a diverse selection of business across different sort of business sectors and geographies. You know, we often joke internally that for us, boring is good. You know, we don't go near oil and gas, we don't go near mining, no biotech, and really no startups. We want businesses that have a long-standing history of EBITDA. And sort of unlikely to be too jazzy and glitzy. So we have 11 partners currently. You'll see the bottom right tombstone, Extreme Push. We had our first successful exit back in September at a fairly healthy IRR of 22%.
And Hugo, it's just thank you, and it's very good to also note that what business situation there was, and then management buyouts and acquisition capital is a theme that you will see as a very good use case for our capital. As I said, we're not all things to all people. There's some companies that are too small and startups, and so we don't do those type of companies without a track record of EBITDA. And but there's a sweet spot for us. If they're too large and they don't care about the refinancing risk, or they believe that, you know, in 5 years it's a very high growth sector, which actually Extreme Push became very good. COVID, they were in the eye of the hurricane in COVID, and so buyouts are a big tenet of what we do. There is a life cycle. There is, we want the companies to grow, and that will reduce our risk. And but at one time, if they do feel that they can get a lower cost of capital, and they're willing to take on that risk because they've grown to a size. We understand that that there are lower cost of capital out there. As part of what we do, we get our capital back, and I should mention, we got our when there is a buyout, we get our capital back, plus we got a prepayment penalty or a redemption premium, as we call it, and that allows us to reinvest the exact same amount of capital as we started with, plus it gives us a boosts our IRR. So it is a disincentive, because we don't want this to be churning in terms of using us like a bridge loan to something else. So we really are looking for long-term partners, but we understand, for example, the extreme push. We got our principal back. We got a positive IRR kicker on that, and they're happy. They've got a larger facility with a bank and going into the United States for their growth, and so that's really that's on the positive side. I'll tell you, when we talk about COVID, and Hugo talked about the forbearance agreements. We talked, and we had trading updates all throughout 2020. It was important for us to on a regular basis talk about our portfolio, and we talked about the consumer-facing companies, and we had most of our shareholders will know one of the first deal that we ever did was Riverboat Cruise Company, and we had such a we had the first mortgages over the ships that were value and asset coverage of more than 1 times of our capital investment, and these boats were fully booked for 2 years out. Very good visibility on this, but when you think of a pandemic and you think that we have cruise ships and they're going through Central Europe and full of 80-year-olds. It wasn't. It was just a real unfortunate confluence of events. The entire industry halted production, halted cruising through to most of the summer. They are back, but what we had to do is, and this is one of the things, we have senior security. We are a loan that has senior security, and we have the first rights to the assets. So we can work with these companies to produce an outcome. And in this case, we now took possession of the boats in our own name, and we're working with the management to try and get the boats on the water the next year. If that isn't possible with the existing boat owners or the previous boat owners, there are bigger companies and better counterparties that we can. So that's one aspect, on the downside. But what I want to point out is that our fair value through the BDO process of our audit in the summer of 2020, our fair value went from 13 million pounds to 10.5. So I didn't go to zero, but the fair value, and I won't steal Hugo's thunder about our numbers that we released yesterday. But just to show you the downside, we are protected in that we are restructuring different companies like Pearl & Dean, but we have a group. If you know our companies, Lynx Equity is a mini conglomerate. Pearl & Dean is one subsidiary of our royalty partner, which is called Step Investments, and they have a mini conglomerate. So we are protected on the downside, and we have security over all of those different subsidiaries. So our portfolio did get affected in the negative way, especially as those two companies. But on the positive side, that is why you need a portfolio and a different variety of industries. We have different variety of jurisdictions that we're in, and of course the sectors. The Myriad, for example, is the UK's largest RV and caravan parts distributor, and the staycation market has really come as a boost to their business. They're doing, £3.5 million of EBITDA, and they owe us $1 million and change a year. So that has been very good for the business owners of Myriad. Welltel is the other one. We put two acquisitions together for them during COVID and during 2020 because the work from home is one of their it's a boost to their business. So we've had some positives, we've had the negatives, but the most important thing I want people to take away from what we do is that is why royalties have been around for 40 years. We have downside protection, and now we can talk about this crisis that our portfolio has lived through, instead of in 08, what happens when in different jurisdictions, because we're the only ones in the UK doing this. So Hugo will get to the numbers, but I wanted to give you a flavor of some of the positives and negatives of 2020. I'm really proud of our team that helped these business owners through a very difficult situation through no fault of their own, and we've been able to support those businesses. I won't dwell on the slide, but just to give you a flavor of what we do. We had Mark Harrison. We were introduced to Mark Harrison as a referral from one of our other royalty partners, and he was facing the redemption premiums for his British Growth Fund, and at the same time he had an opportunity to buy a company. And so British Growth Fund didn't want to give him more money; they wanted their capital back. So he was facing a refinancing event. He came to us and had not heard of what we did before, but we showed him, and I think the bottom right really speaks to what he was facing. It was, the first 2 years, I can get cheaper financing on a cash flow, but there's no way that I can have years 3, 4, and 5 be able to service those payments out of my cash flow. So I'm going to have to be, in 2 years, refinancing this again. And what if I want to continue to build through acquisitions? It's interesting to note that 2020, in this slide that we've had for a couple of years, 2020 would have been the time that he would have faced these refinancing events, and that is the exact time that he would not have been able to, because this was one of the ones that for 6 months we reduced his payments, cash payments, and we helped him through the short term because we took the long-term view. And that's what Hugo said about us taking the long-term view of helping companies, because we are his long-term partner, and he's very appreciative of that. There's a video of him on the website at dukeroyalty.com. You go to the partners page. We got 4 different videos that we just we interviewed some of our royalty partners and their experience with us. So go to our website for further due diligence on that. Okay, we're pleased about doing this right as we have our half yearlies fresh off the press from yesterday. So Hugo, we'll turn over to you.
Thank you, Neil. Yes, the numbers part. I'll focus on 2 sort of areas in terms of financials of the business: the cash flow side, the cash flow generation of the business, and then the sort of the balance sheet aggregate NAV side. First and foremost, we are a cash generative business that pays out quarterly dividends to our shareholders. So generating that cash is very important to us. The numbers really show sort of 2 sides. It shows you the FY20 numbers, which were just pre-COVID, and it showed where the business was as we went into the pandemic. And then obviously the interim 21 numbers, which we've just released, which really have been us trading right through the pain of COVID. And what you see is cash revenue of 4.4 million, which is down circa 15% from the comparative period last year. but actually net cash flow, operating cash flow, held up well at 3.6 million, only just down on the 3.9 from the comparative period. So our cash flow has held up. There's no hiding from the fact that, you know, we, as I alluded to earlier, we structure forbearance agreements, and we have foregone some of that cash in the last 6 months, but for the most part, the cash flows have held up very well. And even, you know, the cash flow generation currently is producing enough cash flow that we're on the current dividend of 0.5p a quarter annualized to 2p, is still showing a 7% dividend yield at the current share price. So I think that sort of shows, you know, where there's room to grow for this business, given that we've just witnessed 6 months, which I hope we won't see again for a while, and yet the dividend yield is still holding. I think it's important to note that as our revenues grow, you know, we're a very leveraged operationally. We have a very stable fixed cost base. So as you see that top line cash revenue number going up, the core operating expenses should remain, you know, relatively stable. I think with all growth comes the small additional costs, but I think as we grow, that operational leverage will only increase. And then moving on to the balance sheet side of things. Now, you know, Neil touched on the fair values of the investments which underpin our net asset value. I won't bore you with the intricacies of IFRS 9 accounting and how I spend months with BDO valuing all of these investments, but suffice to say,
that would take the other half hour, and we got to get to questions.
Well, I'll send people to sleep. But suffice to say, you know, the bulk of the audit work took place June, July, when we were right in the eye of the storm, and, you know, gone through 3 months of lockdown. The models are really driven by the growth rates of our businesses, and as I'm sure you can understand, growth rates fell off a cliff for the next 12 months. And what happened meant that our +6 adjustment factor for the next 12 months turned into a -6 adjustment factor for a lot of these businesses who saw their revenues literally disappear. So we incurred significant write-downs in FY20 in our annual report, 15.5 million. But our balance sheet has started to recover. So the NAV was 74 million at 31st of March. We've recovered, you know, a small amount, 77 million. And I'll touch upon that sort of in the upside blue circle. You'll see the gradual re-rating of the fair value portfolio. And somebody has actually asked a question, which I might just touch on now, actually, which asked whether the interim results are unaudited. What extent were the asset carrying fair values reviewed at half year? And will they be revisited going forwards? Well, yes, the fair values are looked at half year. I do a thorough review of them. Given that we only released our annual report 2.5 months ago, I hope you wouldn't expect to see a significant change in that. And the way the fair values work is yes, we took a 15.5 million write down. You won't see a V-shaped recovery on those, but what you should see is a gradual re-rating of that fair value portfolio. So, and actually, the back end of the question also said, are the fair value assets ever revalued above their original cost or capped? Yes, they are. The fair value can go above cost, because if the business starts to show more and more growth, the discounted cash flows only increase that fair value. So we're currently, the portfolio is sitting about 6 million below cost, and I would expect over the next 18 months for that value to be clawed back. Other upsides on the balance sheet you should be aware of, Neil alluded to that, all of our royalty investments have redemption premiums attached to them, which on the current portfolio is around sort of just over 15 million of premiums. Now, those aren't really baked into the fair value because the models are really a 30-year discounted cash flow. So that sort of 2 million kicker or 3 million kicker on refinance effectively sits in the model at a 30-year discount. So there's significant premiums there. And then lastly, I'll just touch on the equity stakes. As I mentioned, we took 3 equity stakes in the businesses through the full-born interest. We also hold 4 stakes in other businesses which were prudently valued at under 200,000 at year end. Again, through the audit, this was, you know, we were audited back in July. value is really based on a forecast EBITDA, and then a multiple added to that, and is the EBITDA clearly reduced significantly for this financial year. That had a sort of fairly significant knock-on effect on the equity stakes. Now, just touching on the equity stakes, 3 or 4 questions have asked us about how we think we can monetize those equity stakes. It's, we can't lie; these are all equity stakes held in private businesses. So those will be monetized really through one of 2 ways, really: a trade sale of the business, or we will be refinanced out. Generally, if we're going to get refinanced out, we will look to negotiate an exit on those equity premiums as well. So it is reliant on there being a sale of the business or that refinancing. But all of our investments hold a 3-year non-call. And now we're sort of coming to the end of certainly of the early ones, and I think as we start to go through what we see as the sort of sweet spot of refinancing, generally about 4 to 6 years, I hope that we can expect to see some both refinancing of our royalties, but also some of these business owners, they're MBOs, and a lot of the management team don't want to be in it for 20, 30 years. They've bought out the incumbent management, and they want to grow the business, and they want to monetize that as well. So there's definitely room for these businesses to be sold.
And Hugo, that's a good point, because again, acquisition capital, the buy and build, we provide additional tranches of capital to the same royalty partners, which is great for us because it's the same return and a lower risk, as we build these companies. But, the life cycle is part of the model, as you say, which then unlocks those kind of upsides, redemption premiums, and those things that are not in the fair value. So, yeah, good point. Talking about upside surprises that aren't in the fair value, I really think that the benefits for investors. I see that most of you are investors, so thank you so much for your time, and we won't dwell on this. We'll get to questions here in the next couple minutes. But for those of you who aren't, really a compounding and annuity-like revenue streams is what you can expect. The compounding opportunity, because of that re-rating and that royalty aspect, we are participants in the growth of these companies. And then, on the downside, we take some, we're capped at 6% in dollar figures lower than we were the year before. So there is a cap on the collar of our compounding opportunity. But that gets reset once per year on the upside and the downside. And so, for Lynx equity, we had two years of +6s as they grew, and now we're a -6, which Hugo explained the fair value adjustments as we go through. But at the end of the day, we look at the cash flow generation of this company and that ability to pay the dividends, which is a commitment of our company to pay our shareholders dividends. I am a very large shareholder myself, as is Charlie Brooks. That we started the company. We've participated in every round alongside our institutional shareholders. So we love dividends as much as our shareholders. That's one of the things that that you can count on us for. But as we grow and as we get more capital through debt or equity, the yield compression, as we reduce the risk, happens. Diversification through additional revenue streams and additional partners, as well as the liquidity of shares. So that's what we're committed to. That's a bigger company is less risky, and we're still building and growing our company. And just alongside all of you who are shareholders, these are our declared over 3% shareholders. We're really excited that we have a big and stable group of shareholders. Institutions have been with us since 2017 and participate in every round, as well as the liquidity that has been built through doing things like this, quite frankly. And I probably have seen some of you at the Mello conferences and the Shares conference that we put on. So hopefully we'll meet again in person sometime soon. But that has built the liquidity of the company and the knowledge base of our company that we're committed to, and we're in the top quartile of AIM value traded stocks so far this year in 2020. And I touched on this. We're going to get to questions. Just pipeline is probably one of your questions, which we now think that coming out of COVID, the banks are going to look terrible again, just like they did in 2008 and 9. No one's going to forget the fact that the banks, even with an 80% government backing in these CBIL loans, they were very hard to come by in the time of need for small businesses. The high street banks have just too many regulations on them. The bank managers, have a box that if it needs to fit in this box, we are part of this alternative financing industry that has really blossomed in the last 10 years, and I believe will continue. And for us, our little company, we don't need to be the biggest and the best. We're looking at over 65 million pounds worth of opportunities right now. We think 2021 is going to be really the year that people have looking forward and refinancing some of these companies. We're not looking at any companies that are in trouble. We want to help companies grow and take advantage of the opportunities that they have, and so that's what we're looking forward to. We do have 20 million pounds of spare capacity, liquidity through the cash on our balance sheet and the debt line that we currently have. And so we'll get to questions. Really, the summary here is that we have the established product. We have an established portfolio. We resumed our cash dividends through the COVID period, but what we have done for the 6 months that we had to help our companies, and we had to reduce our cash inflow and therefore the cash to you. What did we do? What did we do for our shareholders? We have now long-term embedded value in these companies. One of the questions is about the psychology of taking equity. I'll get to that. But we not only have the fair value long-term upside, but we have the embedded cash flow upside. As the full reinstatement of the cash flow resumes to our existing portfolio, and the buyouts and the companies that we're evaluating, we're under an exclusive period right now with a new royalty partner. In the new year, we'll be talking about that. I sure hope, and the future in the global macro picture is also very bright. So thank you for your attention. I'll turn it back, and we'll go to questions.
Thank you very much indeed to both Hugo and to Neil. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. But just while the company take a few moments to review the investor questions that have been submitted today, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your Investor Meet Company dashboard. You'll receive an email notification when that's ready for you to access. I'd also like to remind you that your feedback is important to the company, and immediately after the presentation has ended, you'll be redirected for the opportunity to provide feedback in order that the company can better understand your views and expectations, and would very highly recommend doing that if you could spare the time. Hugo, Neil, investors did have the ability to submit questions. We had 4. You've answered one in the presentation. Perhaps I could start off with you, Neil. The first question reads, how do you intend to fund both future potential capital payments to royalty partners and cash dividends?
Yeah, it's a good question. I mean, the point of this model, and we are replicating a proven model in North America, is that we continue to fund through the equity issuances. We've done 4 equity issuances so far, and that really builds the opportunity and the yeah, now I'm screwing that one up. That was that was submitted before this too. The operational leverage. Thank you. So that's the vagrancies of live presentations. The operational leverage comes through us deploying more and more capital. And so it benefits all shareholders, and so that again has been proven through what we do. The real tenet of our company is the cash flow to the shareholders, the dividends. We're a cash flow vehicle, and we believe that the company it has that discipline of returning cash flow. It goes to what we're compensated on. We have a salary, and we're not a fund, so that's a fixed cost base. The only way we are aligned in our compensation to grow the cash flow per share of the company. So that means that the per share aspect has to grow, and that's why we both believe that dividends are important, and grow through equity and debt. As we've layered on debt, that's part of the model as well. But both of those things are important.
Thanks ever so much indeed, Neil. Perhaps, Hugo, I could address this question to you. 4.2 million of the group's loan investments mature within a year. What is the interest rates on those loans? And is it the group's intention to redeem them, or are they more likely to be rolled?
Thank you, Mark. In actual fact, that number's changed as of yesterday, and is now sitting at 5.2 million. So I say just under 3.5 of that relates to Marker, which Neil referred to earlier, our river cruising business, and that loan will actually, as we have seized the assets there, that loan will be rolled into the fair value that we've assigned to the boats. The remainder relates to 1.3 million loan, which is actually in the process of being rolled up into a royalty financing instrument, and the third loan really is a small £700,000 loan, which is actually on a quarterly revolving basis, and we kind of expect that to be refinanced in the next sort of 12 to 18 months.
That's brilliant, thank you. And finally, the last question that we received, and I know you've probably touched on parts of this, but if a partner entered into an insolvency process and was restructured, for example, by a pre-pack, would your contractual obligations survive that process and attach to the hived up business, or would they cease for potential capital and income loss?
Yeah, that goes to the heart of our downside protection, which is we have senior security of these loans. So the pre-pack process, we would be in control of an insolvency. And so for example, Tamarka, we work with the owners. They have a seasonal business, and so we were able to control the process with them. And so the pre-pack would be our pre-pack. And then we would be able to restructure the company in any way. I think that what we have proven in COVID is the first thing we do, because these are fundamentally profitable companies, is that we work with the company on a short-term basis to try and ease the cash flow, keep cash inside the business, to restructure in some way and keep them an operating company. If we went to an insolvency process and tried to do a fire sale of assets, most of the companies are not like Tamarka, that we have one-time asset backing, the more cash flow loans, and so we wouldn't put them through a pre-pack. But ultimately, the royalties, we have intercreditor agreements for any other bank that we have. So we are protected, and we are top of the tree. So that's the answer to the question. When we are in control of the process.
That's brilliant. Thank you ever so much indeed. Neil, Hugo, perhaps I could just ask you to click on the Q&A tab. You can see there's a considerable number of questions that have come in today. If I could ask you to perhaps read out who the question's from, along with the questions. You said earlier this is a live event, so there's plenty of, as you can see, plenty of investors here. We've got about 10 minutes or so, but feel free whatever time you need, and then hand back to me, and then I'll redirect investors to give feedback. Thank you.
Sure. There's one theme that I think a lot of people are asking about, the equity stakes that we've picked up. I think the first statement to say is that while we don't look, there's some situations that, like for growth capital and whatnot, that we do not get or anticipate getting any equity. But for an MBO situation, some equity, when we are recrafting all equity stakes, there are an opportunity for us to get some sweeteners in equity, and they're minority stakes. And so that's why it's minimally dilutive. We usually don't, and they're not part of the return that we need. But when available, we, on behalf of the shareholders, we're going to pick up some embedded value in equity stakes. The other part of that question are the new equity stakes that we've taken through this process, and is that incongruent with our model? There are some, and InterHealth is one that is a deferment of the payments, and they are anticipating a refinancing of a hospital loan. So that is not equity stakes. That's just a deferment of our cash flow. But the ones that we have, like United Glass, we did is in conjunction with the agreement of the equity partners and the owners, and so that is the best thing that they did. There are different ways that we can do, and we can preserve the value. There's also capitalization. So we could say, well, you missed £500,000 of payment. You owe us 7 million. Now would make it 7.5, and you're going to pay the royalty payment on 7.5 instead of 7. And so it just we go into we have a range of different options that we can do, but it's what's best for the different companies. So, but we are not in direct conflict with the business owners, and that's really what we're looking for: alignment with the business owners. Hugo, have you picked out one that?
Yeah, no, absolutely. I'll just
we'll go back and forth, shall we?
Yeah, I think that's the way to do it. I'll just respond to Douglas K, who has asked, does Duke take any currency risk in their loans? Douglas, I try very hard to ensure that we don't take currency risk. It's well known that we have a number of royalty investments in Ireland, so theoretically could be exposed to the euro, and also our riverboats. Currently, we do have a little bit of exposure, certainly to the euro in terms of the ownership of our riverboats. But wherever possible, I ensure that we structure the loan in sterling. And while our royalty partners may receive euros, when they pay us back upon refinancing, they will pay us back the sum in sterling. And all of our royalty payments, bar our smallest royalty partner, are paid in sterling.
There's a good question about ESG, and we do have an informal ESG policy. We are formalizing one, and that kind of got interrupted with the COVID situation. But the first thing to remember is we are going into kind of Western Europe and North America. That's where we're looking for our royalty partners. So, we want a robust rule of law. Corporate governance is important to us, and for the royalty partners, what we found, when we look at what we really need to focus on is good financial reporting. We get monthly statements from every one of our companies, and we need the finance function to have to be robust. On the environmental side, we are conscious of what industries we are in, and that they're doing their best in whatever industry they're in, and they have in their industry best practices, and socially, again, we're conscious of those things, and we take a look at them. Formalizing that process in our investment book is something for the near future, and you'll see more on us from that.
There's a question here from James C. Please, can you clarify where you currently stand on any LTV covenants and related headroom? Given the strong pipeline, is there sufficient LTV headroom on balance sheet to pursue deals without further equity raises? James, good question. Yes, we do have an internal LTV covenant, which we have the ability to breach, but we like to stay within. What that means really is that we're in a net debt position of just under 15 million. We have a debt facility currently, which can take us up to 30 million, but that also has an accordion facility for an extra 20. So the debt facility on an aggregate level gives us 50 million of sort of aggregate firepower. But currently, I would say we've got about 20 million of sort of spare cash and available firepower to invest over the next 3 to 6 months before we even need to think about going out for an equity raise.
Right. I'm just trying to have something in the last 4 minutes that we.
There's a quick one here, Neil. I can answer fairly quickly. From Richard G. Thank you. Have you generated any useful tax losses as a result of the recent write-downs? And if so, how does that position look currently? Yeah, spot on, Richard. Absolutely. We posted a 10 million PBT loss last financial year. With the way the group's structured, we do have a holding company in Guernsey, which is outside of sort of the UK tax, obviously. But we generated 4 to 5 million of UK tax losses last year. So yes, those will be utilised, and pleasing to say, I would imagine all of those losses will be utilised this current financial year.
There's one here about when you have significant equity stakes in finance companies. Thank you, Douglas K. Do you seek board positions? And yes, that is one of the downside protections that we have. When everything is going great, they're paying us. They keep more than half of the revenue. The cash flows. And they're happy. We're happy. There's no covenant breaches. As in what happened. One of the things that we have as a protection is to take board seats. So as companies go into these forbearance, we have a board seat on UGG and Trimite, and so those are some of the things that we do. So I think that's you will see that, and again, those don't have to be permanent. But we are incentivized to keep the company growing and to help the company. So unlike just your bank manager who's always looking for his downside and trying to get his money back when the term loan comes up or sell you another product, we're helping the management kind of grow the business, and we're aligned in that way. So they welcome us on the board. And I would, there's one last one here. I'll have to get to that and then we'll go to the dividends. There's one about, I think we'll end with the pipeline and the future. I can't name names, but I think one of the central tenets of our business is to know companies that have been around and been through multiple cycles. There's a company that's over 20 years old that is the one that we have under exclusivity terms. It is an MBO. The existing vendors are leaving it to their employees, two of which have been there for over 30 years. So the continuity is beautiful. The CFO really knows the numbers. The company is in a growth sector, including electric vehicle charging stations. There's some. That's their future, but their bread and butter is in more infrastructure type things, and so we're really excited about what that means in the future, and more opportunities like that. So thank you so much.
That's brilliant. Thank you very much indeed to both Hugo and Neil, and just to investors who have submitted questions, perhaps those that might come in after we as we wrap up. Obviously, we'll make these available to the company as well. So thank you once again for submitting and taking the time to submit those questions. Neil, perhaps I could just ask you just for a few closing remarks, and then I know investor feedback is incredibly important, and we'll redirect investors to provide that to you.
I would just say thank you. I do want to point out that on LinkedIn we are taking a more proactive approach. Please follow us on LinkedIn. We're doing things, posting about alternative financing, and really trying to be in the community. And we can take questions there, and that'll keep us having a dialogue. And we don't do Twitter, but you know, we're a small team. So, but I regularly look at what we're doing on LinkedIn and what people are saying. So please follow us on that. And hope to see you again, either virtually like this or in person in one of our conferences.
That's perfect. Thank you very much indeed. And thank you for updating investors so soon after your results. So thank you once again. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide feedback. If you access this meeting from our website, the feedback page will appear. And if you access this via the link sent you by email, you'll simply be asked to log in just to submit your feedback. But it is incredibly valued to the company that they understand your views and expectations. So on behalf of the management team of Duke Royalty, I'd like to thank you for attending today's presentation. That now concludes today's session, and good afternoon to you all. Thanks once again.